Hey everyone, in this video we're going to be discussing arguably the most important topic in accounting, debits and credits. Debits and credits are the reason it's called the double entry accounting system. But before we jump into what debits and credits are, we first need to understand when we use them. And in order to understand that, we need to define what an accounting transaction is. An accounting transaction can be summarized as a business event that must be recorded in a company's books, and it is measured in monetary terms. We record events that affect assets, liabilities, and/or equity. We do not record events that do not affect one or more of those three elements. For example, if our company performs services in exchange for money, we have an accounting transaction. Similarly, if our company performs services in exchange for the promise of receiving money, again, we have an accounting transaction. However, if our company submits a bid to a potential customer to perform services, we may have a business event, but we do not have an accounting transaction. So now that we've covered what an accounting transaction is, let's revisit the accounting equation we discussed last video. If you recall, and I really hope you do, the accounting equation is assets equal liabilities plus equity. However, we can take it a step further. Let's break down what makes up the equity section. Like we said last video, equity can be thought of as what we owe to ownership. And we can separate equity into stock plus retained earnings. Retained earnings essentially is the accumulation of profit in the business, or the profit remaining after the owners take their draws or dividends. That helps us a little bit, but we can dig deeper. Let's now take retained earnings and break it down into two components. Net income less dividends. And finally, net income can be separated into revenues less expenses. So our new accounting equation is assets equal liabilities plus stock plus revenues less expenses less dividends. Now, revenues and expenses are common terms you've probably heard before, and you might have a general understanding of the concept, but let's define them both. We can think of revenue as an increase in a business's assets due to the performance of services or sale of goods. And we can look at expenses as decreases in assets incurred in operating a business. When we take our revenues and subtract out our expenses, we're left with our profit or net income. Let's wrap up this new concept we just established with an example. Let's say we run a consulting business providing services to our customers. Our first accounting transaction is we perform services for a customer in exchange for $100 cash. Next, we pay $50 in wages in cash. And lastly, we buy supplies on account for $10. Let's run through this step by step, looking at the accounting equation. For the first transaction, we have revenue of $100, and we receive cash, which is an asset of $100. So let's insert that into our equation. Under assets, I'll put 100, and under revenues, I'll also put 100. Next, we paid wages of $50, which is an expense, right? Because this is a use of our resources incurred in running the business. So under expenses, I'll put $50, and under assets, I'm going to put minus $50. Lastly, we bought $10 of supplies on account. So again, we have expenses, this time of $10 for the supplies. It'll be a little different on the other side though, because instead of hitting cash, we're going to hit liabilities, since we bought the supplies on account, also known as accounts payable. So I'm going to put $10 under liabilities. We can now check to make sure the accounting equation ties. On the left, we have net assets remaining of $50. On the right, we have liabilities of $10. And under equity, we have $100 in revenue less $60 in expenses, which is $40. So on the right, we have $10 and $40 equals $50. So we can see it ties. With our new viewpoint of the accounting equation, where do we go from here? I think this is a good point for us to finally discuss debits and credits. Debits and credits might seem daunting at first, but once you get the hang of it, you'll be fine, I promise. The hardest part is drilling the information into your mind. So there are a lot of mnemonic devices out there for memorizing debits and credits. The key is to find out which one works for you. For me, I learned DED. It's super simple. DED stands for debit, expenses, assets, and dividends or draws. That's it. So if I want to increase the balance of one of these accounts, I debit it. If I want to increase the balance of any account that is not an expense, asset, or dividend or draw, I have to credit it. Debits are always presented as positive numbers, and credits are presented as negative, and the debits and credits in a transaction will always zero out, as we'll see in an example. Please note though, negative balances are not necessarily bad in accounting. We'll also see how that plays out in an example in a few moments as well. So I personally use DED, but I've also seen dealer as a positive one. But the concept is the same. Dealer just stands for dividends, expenses, assets, we debit these, and liabilities, equity, and revenue, we credit. The decision is up to you what you want to use. I won't sway you anyway. Everybody is different, so if you find something that works for you, go for it. For this course, I'll be using DED, but I encourage anyone watching to decide for themselves. So let's take that example we just looked at before with our consulting business, and let's see how the debits and credits work out. I'm going to set up two tables to show you how it's going to work. Okay, so our first transaction was our performance of services for $100. Cash is an asset, and if we remember DED, we know that in order to increase an asset, we have to debit it. So for our first transaction, we have cash and revenue. Like we said, we're going to debit cash, $100. If we look at DED again, we know revenue is not included in DED. So in order to increase an account that's not included in DED, we have to credit it. So we're going to credit revenue. And down below, we're going to put 100 under cash because we debited cash for 100, and we're going to put minus 100 for revenue because we credited it. Like I said a few moments ago, a negative balance isn't necessarily a bad thing. In this case, a negative balance is good because it means we performed services and made money. And if we look at our first transaction, we can see we have positive 100 and negative 100, and it equals out to 0. This is why debits and credits are the key to double entry accounting. Every transaction must equal 0 no matter what. You should never run into a situation in which your debits and credits do not equal 0, no matter how complex of a transaction you have. Let's wrap this example and the video up now. Our second transaction was paying wages of $50. Wages are an expense account, so let's look at DED. We can see in order to increase an expense account, we have to debit it. So I'm going to write for the second transaction, wage expense, $50. The other side of the entry is cash, which is an asset, as we've already said. But wait, I thought assets get debited, right? If we look at DED, we see assets, debit. But we've already debited wage expense, so how can we debit both of them? Right, assets get debited when we want to increase the account. But in this instance, we're paying $50 and decreasing our cash asset. So we actually end up crediting cash in order to reflect the payment of $50. So let's put cash and 50 under credit. And down below, we're going to put minus 50 under cash And for wages, we're going to put 50. Again, the sum equals 0. And our third and final transaction was the purchase of supplies on account. Supplies is an expense account, so we're going to debit it $10 to increase it. So we'll put supplies, and we'll put 10. Now let's look at DED to figure out whether to debit or credit accounts payable, which is a liability. If you remember that debits and credits must always be 0, you probably already know what we're going to do. But let's take a look at DED, and we can see liabilities are not in here. So we can be certain that we must credit our liability account, accounts payable, in order to increase it. So down below, again, supplies, I have a debit of 10, and I credited accounts payable $10 above to increase the liability account, and of course, it equals 0. I think this is a good place for us to stop. We have a lot more to do still, but we covered a lot of material in this video. The way we've recorded transactions above might be fine for a small number of transactions, but as you can imagine, when you have a company recording thousands of transactions per day, this is not a very efficient system for maintaining records. Over the course of the next several videos, we're going to introduce the accounting cycle and see how companies actually record transactions and keep their books. But until next time, thanks for watching.